again. It's nice to be back with a whole new set of panelists and a new topic, liquidity, one of my favorites. So I guess from a liquidity perspective, people in traditional asset classes and on most panels start with flash crashes, liquidity gaps, and issues. You know, where do we have problems? So maybe let's do that. Does crypto have a liquidity problem at the moment? We can start from the far end, please. Leon.
Yeah, a pleasure to be here and to be on this panel with so many friends and colleagues and partners. I lead the sales team at Galaxy Digital. We're a US-based sell-side firm focused in the digital asset space. I don't think that crypto has a liquidity problem. If you take a look at what's taken place over the last year, you've seen $35 billion net enter the space into ETFs. These are all folks who could have bought Bitcoin through Galaxy, through Coinbase, or any of the other partners over the last few years. They did not. They've added to products like IBIT and other tickers in the space. What that tells me is that there is a brand new participant entering into the space. And this new participant is, in part, both retail and institutional. A lot of institutional players are choosing to choose traditional products, and the reason they're choosing to do that is because they see a few risks dealing with the underlying asset class for whatever reason, but a lot of that is to do with credit risk and to do with custody. And then those retail players are also choosing to choose products like the ETF as well. So that's pretty much changed the market structure. And I don't see that changing anytime soon. But I think that's a good thing for the asset class because we see this new marginal buyer and this perpetual bid, I would say, only going to increase in the near term. And so I think that's number one. And then number two, if you take a look at the futures open interest, I think we had roughly 100,000 or 110,000 open interest contracts in the CME at the start of Jan 24. I think now it's something closer to 210,000 Bitcoin denominated units, which is around 50,000 CME contracts. I think that's a very big deal. It shows that this new participant is here to stay and that it's not simply a price increase that we're seeing in the open interest, but rather an actual increase in the number of units of open interest. So I don't think that there is a liquidity crisis or a liquidity problem. In fact, if you take a look at crypto as a whole, I think it's like a $3.5 trillion asset class. It trades around 50 billion or so in volume. If you compare that to gold trades about 80 billion on the CME, and it's an $18 trillion underlying asset. So there is actually relatively quite a lot of liquidity in crypto.
Matthias, what do you think? Is there a liquidity problem?
No, I would agree that there isn't really. There has been an evolution of where the liquidity came from, right? If you take you back to the crisis year 2022, all the scandals led to a trust crisis. So there was a time where actually the Uniswap ETH trading volume was bigger than on Coinbase at some point. So an overall DEX to centralized exchange liquidity was around 20% at some point because obviously nobody trusted centralized entities anymore. That trust had to be rebuilt, and now I'm not from the lens as a bank focused on crypto. For us, it's not liquidity is not the big issue. We are working with great partners such as even those here on the very panel with me, where we can ensure best price execution, etc. We are much more focused on still counterparty risk. How do you manage settlement? How do you manage the USD rails, cyber? So that's much more the topic than liquidity.
Before we come to you, Thomas, could we please flash up the little chart I prepared? It's basically just a chart that shows you ETF trade volumes versus leading US exchanges. Lovely chart from Kaiko. I just wanted to kind of flash this up to illustrate the point that Leon was making, and also to come to you, Thomas. You have obviously a good view of what liquidity conditions are. Can you tell us a little bit about how they've changed? How are they compared to, say, a traditional asset class like foreign exchange? What sort of sizes can you do in crypto and how that's changed, and where people are trading?
Let's start here if you have, because you've done the work of putting interesting information in front of us. We trade about 5 billion a day of ETF Bitcoin. So that's $150 billion a month, roughly. So how much of that? And that's all new business, right? This is not the crypto participant that suddenly started trading ETF. This is new participants that were now allowed to enter the space. So this is new liquidity that came into the market. And what's 150 billion a month? The total spot trading volume, November, December, is about $3 trillion across all coins. So if you narrow that down to Bitcoin, you probably have 750 billion to a trillion is Bitcoin, so you have almost 15% in the ETF of new liquidity. Just rough numbers. This is the order of magnitude of the things that have changed. And I think I don't want to do comparison to 22, but probably to 21. Last time we had the highs, we haven't reconquered the highs in spot trading volume. So actually, we used to trade more spot. Or the spikes in spots were higher in 2021. So from that perspective, this is a bit lower. But you see derivatives number, and you start with futures or CFDs or other derivatives that participants can trade and started to embrace, or new exchange have started to offer to their clients. This is printing new record. Trades about 15% above where it was 2021. And then you have the option market, which people have talked about for a long time. This one's about 4 times bigger than what it was in 2021. So I think what's really moving is not the visible spot liquidity as we know it, it's all the other pieces of the ecosystem, all the other financial products that are needed to make a complete market. And these are the numbers that have changed materially over the last 4 years. It means new players, it means new products offered by all the participant ecosystem, and it's going to carry on. And I'll leave you with, is liquidity improved? I'll leave you with 2 metrics that talks to stability. And the first one is the basis, is the yield that you could earn in 2021 when the market was going through the roof, which peaked at 225%. People were borrowing dollars at 225%. Lovely business to be on the other side. But today, on the rally we've seen this year, we've never really seen excess above 25%. It's still quite high in Bitcoin. It's still quite high for any asset class, but it's 10 times smaller than what it was in 2021. Why? Because you have, well, this is public data, so I'll name them, but you'll have Millennium, you'll have 0.72, because they are named as the largest holder. It's disclosed, it's public. And but they are the biggest holders of ETF. They don't have outright position. They trade the basis against the CME. So all that is balancing. We have the other side of the retail buyers provided by against capital provider, those tier 1 hedge funds. Even options used to trade at 150 vols for those for whom it resonate. I don't know what asset trades at 150 vol. That was 2021. This time we never peaked above 65%. Wow. Again, because we have a lot of vol sellers against the leverage buyers. So the entire ecosystem is much more balanced, much better distributed against player, has a lot more capital to absorb the variation. So liquidity conditions, are they sufficient? I guess that's the good question. Are they better? Orders of magnitude. Sufficient for whom? I think we need a lot more things, a lot more pieces to be put together for liquidity to become a problem. Right now, it's not a problem. And I'll leave you with one last one. Sorry, then it's all yours. But I think you see for what's public, we've participated in very large liquidations of assets. The resilience of you sell billions and billions of dollars in the market, and the resilience is pretty high. You can't, by looking at the chart, you wouldn't be able to tell when those events were happening, meaning the market absorbed those sellers and buyers on the other side. It depends very easily. So I don't think liquidity is a concern for the business that we're servicing right now.
Thank you. Tim, could you give your perspective, please?
Everything these guys have said is pretty accurate. I think the 2 things I would think about are, number 1, I don't think we've been stressed yet. Like Thomas mentioned, we haven't seen, at Kraken, we've not seen the same volume that we saw in 21, that's largely driven by a lot of retail participation, which has not been as aggressive as it has been. So I think you're probably going to stress the system a little bit more when you start to see some of that come through. I also think there's a little bit of like a tale of two markets here. Bitcoin is really deep, really liquid, has a lot of activity. Kraken trades 600 pairs, and as you go further out the risk curve, I think that's where you start to probably see the more stressed liquidity start to happen. And so whether that's Solana or even further out, you just don't have the depth of institutional activity in terms of markets on CME or just overall activity to absorb what I think will be a lot of retail energy going into the space.
So I don't know if you guys had the chance to listen to Mike's speech earlier. He was, stealing my statistics about BIS numbers in foreign exchange, before prime brokerage became a thing and afterwards. So are there any kind of infrastructure developments that you think will be fueling liquidity further, or liquidity conditions, or changing them one way or another? What are they, and how far are we from being similar to, a foreign exchange type of place? We can start with you, Tim.
Sure. Well, crypto is really inefficient from a capital perspective, and so I think as you see more and more traditional players come into the space, they kind of look at the systems and the way you can actually trade, and they throw up their hands. It doesn't make sense, and I don't think all the tools are there, whether that's kind of the classic prime infrastructure, just the general availability of lots of credit to be able to trade for what are high quality folks. These things haven't been solved. I mean, all of the major exchanges are pre-funded, and that's something that the traditional market isn't used to. And so having someone like a PB in the middle of those things is really important to help bridge the gap between a world that people are used to and a world that settles on the blockchain. And so I think a lot of that's kind of in flux right now in the cycle. And like the most interesting companies we talk to and partner with are all trying to bridge some form of that gap in terms of providing more credit into the market, providing tools so that the investors we work with can kind of hit the types of instruments they want. And a lot of that stuff is stuff we get excited about.
Next thing you know, we're going to have Isda here.
We do.
Any thoughts on infrastructure and maybe gaps, credit, any of this stuff?
Maybe to jump on Tim's thoughts. When you look at where it's traded, and I'll do a comparison to FX as you asked, sorry. When you look at where it's traded, you have one or two exchanges own 30% of the volume. Then you have a group of another 5 that owns about 30%, and then you have another 35 after that, who have about 35% of the market. I think we can say one thing, it's very fragmented. So there's only two things to link all those pools of liquidity. Either we concentrate the liquidity, which has happened in many TradFi markets, notably FX. If you want to trade Eurodollar, you have to go on EBS. If you want to trade pounds, you have to go on Reuters. This is how the market has split forever, and it's still the case. So there's really two markets, and they don't trade the same product. If you look at the CME product, they're dominated by the CME, and they don't trade elsewhere.
And lots of efforts to steal each other's business, right? So it's not like a lack of trying.
So either it consolidates, or we get better at linking the pools. So we talk about primes and their impact in FX. Well, they were great because they would allow HFT and or other types of trading startup to trade and balance two pools, basically connecting them to exchanges without having to deploy the capital everywhere. So if you imagine a prime, well, suddenly if they allow you to trade on the 40 relevant exchange, then they will have players like ourselves, for example, but that's not our core business, linking the liquidity between all those pools. Today, you still need to take your money from one exchange, move it to the next one, move it to the next one. I would have one caveat, which is that's kind of the purpose of on-chain settlement. We can move value very fast, whereas if you're in TradFi, once every 2 days. So when you run out of cash on an exchange, you're going to have to wait for a bit, and therefore primes were even more critical. But they are, tooling pools will need more of those services.
Well, basically, the regulatory frameworks ultimately drive what types of participants join the market, and these markets then again drive innovation and how the market infrastructure is built. And this is now what we're seeing: more regulatory clarity, more institutional adoption. Hence, all the problems that you guys mentioned are still there, are being fixed. I would say over the last 4 years. Many have already sort of been fixed or are on the path of being fixed. Two I would highlight is obviously the counterparty risk topic, right? So in our case, one of the core products is a tri-party agreement where, which basically mirrors traditional infrastructure where clients can hold their assets with us, segregated off balance sheet, but still get the liquidity by having trading margins with the core exchanges, and so then the better of both worlds while still earning a yield on the actual asset that is with us custody. So for everyone, for every player, its place as we know it from traditional finance, and I think that is already a step, but still we have a way to go, and the more market participants will have, the more this will be pushed and the new norm. Second one was obviously the US dollar settlement, right? Moving away from T+2 to 24/7, because everyone has to manage counterparty risks across the value chain. There's various tools now or new networks after some of the breakdowns in the US that are starting to gain traction, but we're not yet there. And the third one is then once the market infrastructure is there, it also then drives what kind of products are being used, and obviously the more institutional it gets, and some you guys have a bit hinted at it, then obviously also futures, derivatives, options are gaining traction. So when you look at traditional markets, futures, market, commodities, FX, it's trillions a day, and if I'm not mistaken, you guys know better, but it's in crypto, it's something like 15 to 20 billion a day right now, but that's very different from spot, where it's 50 to 60 billion a day, which is in Bitcoin, and if you take an asset in traditional securities like Amazon, who has similar market cap, it's 10 billion. So that shows you on the spot, it's very liquid already, but on derivatives and options, not yet, and that's probably the next phase of growth.
I'm telling you, is this going to be here? Leon?
I think the main points have been made already. I think the only thing I would add is that the big change in the ecosystem that I see is that 2 or 3 years ago, there was actually a lot of credit in the system. That's been taken out as folks have been significantly more concerned about credit risk. We've actually seen some part of that met by the ETF flows, so folks getting margin against ETF positions, and that has brought new credit into the system. And I would say derivatives. I would say that's been a form of leverage that folks have been able to get outside of the traditional lending frameworks that they used in the past. And I think that's one reason why we've seen derivatives really boom this year. And we expect, and I think it's pretty fair to say that we expect derivatives to be a core part of the infrastructure next year as well. So I think, it's a boring answer, but I would again point to ETFs for traditional market participants, both as a way of expressing their view, but also getting financing, and the derivatives market as a way for folks gaining leverage and the credit they would otherwise not have been able to get.
Do you see that credit coming back? That you mentioned that there's been a pullback. Where did that credit come from originally? And do you see those players coming back, or do you see new players coming in?
I'm convinced that there will be as the space becomes more institutionalized and as we see regulation, there will be new sets of folks come in, providing that credit. I mean, the pools of capital outside of crypto are vast. Within crypto, it's actually not that big.
Well, we also need new people, right? Because everybody who was lending before blew themselves up, and so. Right.
So the pools outside are vast, but so what I expect is that you'll probably see at some point prudential regulation introduced, which governs how lending takes place, and then I also expect, and I think you see it already, but large pools of capital outside of crypto backing certain prime brokers with their own balance sheet and saying, hey, here's many hundreds of millions, billions of dollars, and you can execute prime, and we understand what you're doing within this box. I think that's the direction the space will go, and I think that's where the new sources of capital will come from.
Can I just make one point?
Please do.
There's already obviously I agree there must be new players. I mean you guys have seen over the last few months leverage has come back. We also see that on our platform. The challenge that we have as a regulated bank is the capital requirements that are being imposed on banks doing on balance sheet business, which obviously derivatives and Lombard lending, etc. is. So our limitation clearly is this. I mean, to some extent, probably makes sense, right? Some of the learnings from what has happened if you don't have these liquidity ratios and counterparty risk ratios, concentration risk ratios, etc. But the way the BIS, etc., is suggesting and is now at the national level being implemented, certainly in Switzerland, there's these discussions. I can just tell you, it will be very difficult to scale these businesses, and they are so prohibitive, particularly, for example, market risks, etc., that there is some education on the basis of data, etc., needed, and hopefully, together with positive lobbying, that we can end up in a space where we can scale sustainably, because otherwise it will always be, even for big players, even a reason to potentially not even get into that space. There have already been players in Switzerland had to stop offering Bitcoin ETFs because the way it was structured, it blew up their balance sheet, etc. And so when it then comes to lending, that will be even more pronounced.
And this is why I think that what happens in the US is so important, because if we see any changes around how Bitcoin is treated as a capital asset on the balance sheets of banks, then I think that would be a market structure change that would see significant, like a complete market structure change in how credit derivatives lending takes place.
I heard, I mean, you know, just a rumor that banks are actually looking to push back a little bit on this. Yes. Because obviously there's a business that they want to get involved in, and it might not make much sense at the moment. Before we move on, I'd just like to remind you that obviously we'll be doing the Q&A bubble afterwards, but if you have any burning questions, you have the app, and then we can, you know, do the ding-dong and ask it at the end. So let's talk a little bit about where people trade, and we have to, I guess, mention DeFi a little bit as well. Is that a space, do you think, that maybe in a couple of years' time we'll be talking about banks being involved? Anyone can go. Thomas?
Sure. Yeah, but there is no reason for banks not to enter this space. We'll start here. Why would they, if the ecosystem is growing, if more participants are coming, which, by the way, today, for most part, used to be the bank's clients, so they're seeing their clients moving away from the banks. Of course, they will get in. To be fair, I'm not on the bank side anymore. So, you know, I'm not that fussed that the capital requirements are really high. I'll say that. But yeah, if the systemic risk is well controlled by the ecosystem that we have here, the capital requirement will go down. Right now, the regulator, or the prudential ones, they're regulating with the data they have from the past, and the data they have from the past says, well, it can get pretty ugly, so make sure you're well capitalized to absorb the market shock. So yeah, I think it's just they needed regulatory clarity. They're getting it in Europe. They will certainly get it in the US in some future. Wonderful. They know the rules. They will play with capital requirements, but even with nasty capital requirements, they will still participate because they are players that will choose to pay a higher price to be able to face a bank rather than facing, well, us or our peers.
Well, yeah. And you said it before, their customers are moving from them to newer players who are doing the crypto services. And so it started in Europe. Every bank is basically looking at how do we provision crypto for our customers. And, you know, our phones have been ringing almost constantly with banks in the US who are figuring out, or other, you know, brokers and similar types who are figuring out, how do I do this and offer this to my customers now that the coast looks clear in terms of what they can offer.
I think one of the numbers that I saw, that I think it was DeFi is now 20% of the total volume of centralized exchanges and spot volumes, which is an all-time high. And I don't see what forces take place to change that trajectory. And so to answer your question, very bullish on DeFi becoming an even more integral part of the space.
Do you think that there'll be a kind of segmentation, like, we see again in foreign exchange, for example, that, some market makers will be, doing Bitcoin and exchanges, and then others will be doing meme coins, somewhere else. Is that the future we're kind of moving towards?
I think that's the current state already, because the business of altcoin, the dynamics of business of altcoins is vastly different from Bitcoin. Is very standardized, high liquidity, high volume, high throughput, and then you have a massive tail. I think, Tim, you were saying you offer 600 coins?
600 trading pairs. Yeah, trading pairs.
I dare
not
anybody
coins,
to
but
name 10% of that.
No.
That would be a good start. But a lot of those, of the tail of the coins, they are project-driven. They are supported by specific market makers who've made a specialty of managing these type of liquidity, and they're addressed to a specific type of participants, which is not your ultra-large hedge fund who was planning to deploy $1 billion and then need to make $100 of return. So you already have that split in terms of capabilities. By the way, a split that exists in equity. You have specialists of small cap, specialists of mid cap, specialists of high volume stocks. So I don't think it's the future. I think this is the now, that splits between capabilities.
Yeah, I was going to say, I love that point that you made, Tom. Like, one of the things that we notice is just the complete difference between what we see at the desk sometimes and what we see in the market. So when we go, we work with a number of family offices and hedge funds, and what they're trading and the thing that is up 48% on that particular day are often totally different things. So what that tells us is that there is a type of participant who at least we're not seeing on an institutional desk that are very active in those names. And I do think that leans to the sort of younger, more degen, Twitter-orientated crowd, in particular for whatever the latest meme is. And nowadays it seems to be sort of AI coins that have replaced some of the general memetic coins. And that's that's just a big eye-opener for us. Like, we see it in other parts of the business and sort of market-making side, but when we see folks come in and deploy assets, it can often be quite different to what you see in the market.
Yeah, well, we see those customers, and that's why we offer such a broad set of trading pairs. I think one of the reasons why people have flocked to DeFi is a progression in how you use crypto. It's also been a reflection of the regulatory environment, where we would like to list everything that our customers would want to trade, and we can't. And so I think as that opens up, I'll be interested to see the dynamic, because all of this is now happening. You want to get the frontier of coins. They're all on DeFi today.
I don't know if this question even makes sense, but do you see any kind of role for AI in liquidity provision?
I mean, yesterday, I think Joe Lubin who said, right, that we have right now, let's take the Ethereum ecosystem, we have, there was this important step to add L2s, or we have about 100 L1s. Within Ethereum, we have various L2s competing for activity, huge, no concentration, no consolidation, and AI and AI agents could be one way of bridging this liquidity and make it look, at least from a user standpoint, a DeFi user standpoint first, that this is one, and hence significantly increase also usability and because, which is a huge inhibitor as well in terms of broader adoption, particularly of DeFi. There, I would say the centralized entities still have often, at least if you look at it from a broad population standpoint, a big advantage. And if you take that away with AI agents and other means, I think this could further boost DEXs and DeFi. But again, looking at it from a regulatory standpoint and managing a bank, we are at the same time far away from having regulatory clarity on what it means for more institutional players to interact in any shape or form with these ecosystems, particularly driven around compliance and the travel rule and how to solve these things. So that interconnection will still remain broken, and that's why you're seeing very different flow than what you just said with your 600 trading pairs.
I also think part of it is because we're in this strange moment where there's a lot of experimentation when it comes to AI coins. So right now, to a large extent, a lot of them are a sort of LLM attached to a Twitter account, and that seems to be sort of the essential product offering. But at the same time, that then generates a community of folks who are interested in it. And the crypto is just sort of a way of like financializing a bunch of community, a lot of especially young men online who are, saying GM to each other every morning and then figuring out what the latest coin is that they want to trade. But that community the community itself is real, and the tokens they trade are sometimes informed by talking to each other, and it may be informed by AI in the future. The other thing which I think is interesting as well, which we've been thinking a lot about, is how the listings of these coins are changing. And so if you see things like Hyperliquid, the way it listed without a bunch of VCs, if you see, and I won't name them, but lots of the online protocols where folks can list new protocols at a click of a button, and you have like millions of tokens being listed every week. I just think we're in this mode of experimentation, and it's not obvious like what that means, like how quickly does something get listed on a centralized exchange, and who's actually buying it if it's not the institutional hedge funds that we're trading with. So I think we're in that mode right now where we're trying to figure out where this experimentation goes, and we sort of follow it like anyone else.
Thank you. So we have 1 minute, so please be nice and brief, succinct with your answers. Where does it all leave retail? What is your expectation? How important are they going to be for the next year or so? Tim?
Huge. I think they're going to drive the next giant wave, which is going to make 2025 a banger.
I share the view. I think we talk about institutional clients most of the time. This is our focus, so slightly biased, but retail have been the driver forever. I see no change to that. Their ability to adopt what we build is orders of magnitude higher than the institutional wealth, so they will remain the driver.
Thank you.
Agreed. We haven't seen the flows from 2021 as outlined for that very reason, that while we had now real institutional adoption, which we didn't have then, that's now the new baseline and growing, but the actual retail flows have not yet come back the way they did before, and that will be a core driver also this year.
Agreed with everything else, and then also checking to see in these first 100 days whether the rhetoric meets the execution.
And I'm ready for my Swiss passport, pretty much, because we are right on time. Thank you so much. So please give a big hand to our panel.